The CEO of the second largest data center real estate investment trust is defending his company against claims that the sector is set to decline into irrelevance. Recently, Jim Chanos, the master of short selling, said that his company had opened a massive short position against data center REITs. According to Chanos, the real problem for data center REITs is technical obsolescence. Their three biggest customers are becoming their biggest competitors. And when your biggest competitors are three of the most vicious competitors in the world, then you have a problem. Chanos argues that although hyperscalers use data center REITs to supplement their own build-out, as they grow more powerful, the margins they will offer will shrink. He added that REITs are overvalued and are in for a period of declining revenue and declining earnings growth. According to Chanos, value was not accruing to bricks and mortar legacy data centers and was instead going to cloud providers. Chanos added that although the cloud is growing, the cloud is their enemy, not their business. Following Chanos' comments and short position disclosure, shares in data center REITs fell. So let's now take a look at a reply from Bill Stein of Digital Realty. In an interview with CNBC, Digital Realty CEO Bill Stein defended his company's business against the claims made by Chanos. According to Stein, demand has never been stronger. Stein said that Digital Realty has had record bookings in the last 2 quarters, with $156 million annualized and $167 million annualized respectively. That's up 30% from the prior quarters. Asked specifically about margins and rental rates, Stein said, "We are increasing our rental rates right now. We've been pushing our rates since the first of the year. We're pushing rates on new leases as well as renewals. Our outlook is very strong. We continue to push rates, and our escalators are now being indexed to CPI, so we're hedged against inflation." Stein also pointed to the company's growth around the world in new markets in Europe and in Africa, and increasing demand from several of the largest cloud service providers in the world. So who is right? Well, let's let the charts decide. And we're now looking at a 20-year monthly chart on Digital Realty Trust, and the symbol is DLR. Now, for disclosure purposes, I do not hold any shares of Digital Realty Trust at this time. I have in the past, and I may in the future. Now, looking at this price chart, you can see here we had difficulty in 2008, 2009, but the difficulty there in 2013 to 2014 seemed to be a little bit more difficult. Now, that is somewhat similar to the difficulties that we seem to be moving through right now in mid-2022. So, is this downturn going to be similar to the downturn in 2013-2014? Well, let's see what the oscillators show. Moving on down here, volume looks fine. Into the MACD, you can see the problem developing. Here we have the top there in late 2021 with a pretty sharp dive down here into mid-22 with the fast line moving just below that zero line. Now the slow line here in red is heading on down pretty quickly as well. There's a pretty good separation between the slow line there and the fast line here, which means we can continue on down or we can continue, say, sideways with volatility. We're not heading up, at least by this chart. So for now, Chanos is winning. Moving down here into the histogram, you can see that the move from that point on the way down here is continuing to accelerate on the downside. We're at a -4. It looks like things may continue down for a little while, before we see some bottoming and basing. I'm not seeing any signs of bottoming and basing yet here, at least by the price rate of change. It looks like a very sharp move on the way down here, probably subsequent to the comments by Chanos. We're at a negative 25, which is almost as low as it was here in 2013. So frankly, I'd be watching this time frame for a pattern that may turn out to be somewhat similar. So moving down here into the relative strength is doing a lot better than it did back in 2013. It's even better than it was back in 2008, 2009. So we'll see how far down this goes. This might be an interesting oscillator to follow. If it doesn't continue on down, this might provide some divergence between the price chart as well as some of the other oscillators. Moving here into stochastic, this continues on down, no bottoming and basing yet. We'll have to wait and see. And the same thing here as we get into the Williams. We're in that oversold territory, but we need to come out above that negative 80 and head on to that negative 50 or midline before I'm convinced that there's any bottoming or basing. So for now, Stein is losing, Chanos is winning. But I think that time is not necessarily on the side of Jim Chanos. I think he's got more time to gain some profits with that shorting. But I don't think that the price chart is going to push too much lower than it is here. But remember, conduct your due diligence. Always check the fundamentals. And for today, that's ChewDog Charts. Thank you.